Today we are interviewing Sandy Rao, a research analyst, and Oktay Kabrak, the general director of Leverage Shares, a European asset management company. It's an honor to meet you. Let's get straight to the point. So I want to start talking about the interest in the Korean market. There has been a growing interest in the Korean market from the global market recently. What is the reason for this?
Well, the predominant reason is a mixture of macroeconomic and geopolitical. In the macroeconomic case, emerging markets countries led in order by India and China are forecasted to have the biggest growth in GDP over the next 2 years as per the IMF and major investment banks all over the world. This means that there's going to be a general increase in consumption. In emerging markets countries, Korean companies have long had a substantial market footprint. In the latter case, Korea finds itself in the epicenter of a movement to diversify production out of China. While India's economic potential is substantially larger, the bulk of its industrial output is geared towards consumption by its 1.2 billion strong and growing populace. Therefore, to feed the world's appetites, Korea, with its stable population and entrenched corporate focus on building a global footprint, finds itself in what could be called a sweet spot.
Can you provide specific examples of the movements in the market? How the flow of the funds goes from the global market to the Korea?
So if we take a look at FSS statistics, it indicates that after a nearly 35% year-on-year drop by value in foreign investor ownership in 2022, January 2023 alone showed a 15% jump in value. Given that KOSPI only went up by a little under 10% in January, this is highly indicative of a net buy-in by foreign investors. Macro factors have also been helpful in making a case for Korean stock ownership. For example, Japan's overweight ownership of US debt is estimated to have led Japanese investors into balancing their portfolios via heavy buy-ins into foreign equities. Korean stocks also benefit from calls on global portfolio managers to diversify beyond China. So far, Korean market trends have provided additional encouragement. For example, the KOSPI is up by nearly 13% in the year to date, while the S&P 500 and the tech-heavy Nasdaq 100 are up by nearly 8% and 20% respectively.
How do you think the outlook for the Korean stock market in the future?
All in all, the sweet spot for the Korean stock market is likely to continue over the course of this year at least. Towards the end of January of this year, the FSC announced broad measures to improve international investor access to Korean markets via measures such as the abolition of the foreign investor registration system, the expansion of scope for OTC transactions by foreign investors, and making disclosures in English for top-of-the-line companies mandatory. This will help enhance flows into the Korean market. However, some market research issues can be foreseen in the future. For example, let's take India's case. Despite India being forecasted as being one of the best performing economies over the next 2 years, the National Stock Exchange, as represented by the Nifty 50, is down by around 3% in the year to date. This might be interpreted by some as there being no confidence in the economic outlook for India. However, the devil is in the details. Assets under custody, which is a term that signifies long-term holdings beyond a quarter, by foreign investors have remained more or less constant over the last 3 or 4 full calendar years, and is even showing signs of an increase in the present year. However, tactical trading, which is mainly driven by multinational algorithmic trading firms and the likes of such, is estimated to have driven down market valuation in phases in the course of a trading session or short inter-day intervals, so on and so forth, which domestic investors have proactively tended to buy up. Like India, Korea is a dynamic and energetic economy. A similar situation has enormous potential to occur even in Korea, which will be hard for market analysts to immediately attribute. Another interesting factor to consider is top-of-the-line companies' concerns over ceding control to foreign interests if international investor controls are eased. For such concerns, you can consider a dual-class share system as a solution, but it remains to be seen if this fear of loss of control would translate to roadblocks towards easing foreign investments.
Thanks for the comment. My next question is for Mr. Kabrak. Why do foreign financial companies view the Korean market positively and want to expand their presence here?
South Korean investors are known for their active approach to trading. Tech stocks, thematic funds, and leveraged ETPs. These are some of the most traded products among the 40+ million trading accounts in the country. This growing trend of retail investing is now capturing the attention of foreign companies who are looking to satisfy that demand. So as the new generation of Korean investors seek out new tools for their portfolios, both foreign and domestic companies are going to help equip them with exactly that. When you think about the fact that a lot of trading nowadays is done on mobile apps, it's easier than ever to trade at the click of a button. So Koreans can trade in the local market in the morning, European in the afternoon, and US markets in the evening. What we're witnessing is the democratization of investing and access to tools that were once reserved for professional money managers.
Okay, what issues should Korean investors pay attention to in the European stock market?
I wouldn't necessarily call them issues, but the European stock market does have peculiarities compared to the US or Asian markets. First, you can often trade most instruments in multiple currencies. So it can be in US dollars, it can be in euros, it can be in pound sterling. The next thing to mention is trading hours. So Korean investors can already get exposure to their favorite US instruments without having to wait for US markets to open. And this is because many of them have European counterparts that start trading a lot earlier in places like London or Frankfurt. And lastly, although the US ETP market is still the oldest and biggest in the world, the European markets still have a few advantages. These include the availability of spot crypto ETPs and also leveraged ETPs that offer higher leverage factors. With that in mind, though, there are things that are slowing down the growth of Europe's markets, and the main one there is fragmentation. So in Europe, each exchange only shows volumes on that particular venue. So a product may seem illiquid just because it trades a limited amount on one venue, but at the same time, it could trade 10 times more on another. So ETF and ETP investors need to keep in mind that there are active market makers supporting these products throughout the trading day. So even if on-screen volume seems low on a particular exchange, there are liquidity providers that can accommodate even very large order sizes. And looking forward, there's really good news for European markets because a recent report shows that over the next 5 years, they're expected to grow at a faster rate compared to the US ETF market. So the future looks bright.
Okay, thank you for sharing your insight today.